Welcome to Shares from the American College of Financial Services. Here's a look at what we'll be sharing with you today.
These used to be a no-brainer. Why wouldn't you do a Roth conversion? But now we have to be a little more careful. And what I'm getting at, when you really dig into the law, what happens is too much income in any one year, for example, from doing a Roth conversion, can really wreak havoc with taxes. I'm Steve Parrish, professor of practice at the American College of Financial Services. So with the July 4th delivery of the One Big Beautiful Bill Act, which from here on I'm just going to call OBBBA, many of you in the financial service field are still working to integrate its changes to tax and retirement and other planning elements into your practices. Now, an area of particular interest as far as its impact on advisors and clients is the ones that may be working in advanced market planning, things like estate tax and business planning. So I'm here today with Mark McLennon, a fellow college professor who specializes in tax and estate planning, and we're going to talk about the impact of OBBBA and some other things happening in the context of advanced planning, focusing on what advisors and clients really ought to keep in mind. So Mark, thanks for joining me on this podcast.
Hey, Steve, thanks. It's great to be here. Love talking about advanced planning stuff. I know there's a lot of things in OBBBA that aren't necessarily what you'd call advanced planning with estate and business planning. We could touch a little on that, but it would be good to talk about some of the impacts it's going to have for those advanced planning topics that we know and love. You and I kind of go way back with this kind of stuff.
And in fact, as you know, since we're both fellow tax geeks, I think you'll understand what I'm going to do next here. I want to take a few minutes up front, just reminding our audience of how tax laws change, sometimes radically over time. So bear with me for a few minutes at the beginning here while I take us all through a whirlwind trip through 45 years of tax legislation. I think it'll help put in perspective how we really have to take these tax changes with a grain of salt and be cautious in our conclusion. So let's start all the way back with the Economic Recovery Tax Act of 1981. So what do we have? A newly elected TV personality named Ronald Reagan initiated the biggest tax decrease ever. These slashes were justified using a hot new economic theory called trickle-down economics. The concept was basically that economic prosperity in the upper classes flows down to lower classes. Sound familiar? Well, that theory worked so well that year that the next year, 1982, we got TEFRA. And that, I'm not making this up, was the biggest tax increase ever, for real. So with the Tax Reform Act of 86, Reagan did get back a lot of his tax reductions, but not all of them. Okay, so we move on to 1988, and presidential candidate George H.W. Bush declared in his campaign, "Read my lips, no new taxes." And then, in 1990, newly elected President Bush increased taxes with OBBBA, not OBBA, OBBBA. Well, this was a really painful congressional debate, and to keep future sessions from simply, changing the rules every time you had a new administration, Congress initiated something called PAYGO. And as many of you listeners know, that requires, if you're going to pass a law with a simple majority, you have to be able to pay for these changes. And that's a big part of the debate that occurred in the making of this law, OBBBA. Okay, 1992, along comes a Democrat, Bill Clinton. He got his tax package, which was an increase. That was a Tax Reform Act of 93. And a lot of us tax nerds, I'm sure you remember this, Mark, we were shocked when the law made many of these increases retroactive. But in the Carlton case, the Supreme Court came in and held that these retroactive changes were neither irrational nor arbitrary. Let's fast forward to the next century. In 2000, in the case of Gore versus U.S., we know the U.S. Supreme Court declared that George Bush beat out Gore. So newly elected President Bush got his tax law, and now we get interesting. EGTRA. Now we're getting to the era where we have those really fun to say tax law names. This was a huge tax reduction. We got a top marginal tax bracket of 35%. They came up with Roths, a lot of things. But also, EGTRA was a law that really set off the politicizing of estate and gift tax law. The newly deemed, they called it the death tax, that was slashed. but we were introduced to a concept of sunsetting. So these tax reductions that they came up with were set to expire years down the line or in 2010. And by the way, we had another Bush era tax law. I'm not making it up, JEGTRA in 2003.
JEGTRA.
Yeah, JEGTRA. Say that after one or two beers in Milwaukee. Just because the electric was really getting used to these fun and weird names. Well, following that, we had 9/11, the dot-com bubble, Great Recession. So there's a lot of things going on and not a lot with taxes. But if you move forward to 2008, that's when we had a new President, Barack Obama. The inevitable tax fight took a few years to develop, but it was a doozy because we had, does anybody remember this term, the fiscal cliff, a rare combination of sunsetting tax laws and at the same time cuts in government spending, threatening the U.S. economy. So during all this wrangling, some laws, such as the estate tax that we'll talk about here, hey, that just plain disappeared for 1 year in 2010. And we got an extension of other tax cuts. And they came up with this kind of temporary tax law just to make it really catchy. This one, I think, is the wildest one. This was Trergica. Well, eventually Congress and the president made nice and passed a law in 2012 called ATRA. And very much like OBBBA, it made a number of tax laws permanent. This is when we got 39.6% marginal tax rate, 20% cap gains, and the intro of the permanent 40% tax rate on estates over 5 million. Well, I think most of you in the audience know where the rest of the story goes. In 2018, we elected another TV personality for president. And as you know, President Trump depermanentized the permanent tax laws with the TCJA, or Tax Cuts Jobs Act. And you all know about the sunsetting, where we had with the sunsetting of tax rates and the qualified business income and state laws, all that sunsetted in order to comply with these PAYGO rules. Well, when he was reelected, President Trump delivered us OBBBA, making some of the provisions permanent again, like tax rates and QBI, and some temporary, like the senior deduction, SALT, and no tax on tips. Why am I telling you all this? Tax laws introduced new concepts like PAYGO and sunsetting and retroactivity, and then they move back and forth between permanent and temporary. So keep this in mind as you work with your clients in factoring into this new tax law. Enough geeking out, Mark. So that was my 45-year history. Now we have OBBBA. So how does this new tax law stack up? Is it usual? Is it unusual? What do we got here?
Well, it's usual in that there's some things that are unusual. But first, I have to make a point. If anyone's actually watching this and seeing, it's like, why is the guy with the headphones laughing and nodding as Steve is talking about all these things? Because I fondly recall a lot of those things happening and having to write about them and, seeing some of the changes. And in fact, you said fiscal cliff. I remember having our Christmas house display we have that has snow and mountains. I put a little sign that says fiscal cliff. It's like, wow, that's, maybe we're too into this, but that was a great kind of jaunt through history, and just to see how, what seems permanent isn't really permanent. But back to your question with OBBBA, and I'm glad you called it OBBBA, because when I try to go OBBBA, I either put one or too many B's in or too few. But OBBBA has a few things that are new you never heard about. There's Trump accounts. That's okay. That's kind of like something for minors, but it's something that's going to last for life. Let's see how long, if they are around 50 years from now, where people have those funds. There's things that get the headlines, like no tax on tips, no tax on overtime. Big thing with the SALT deduction, which does have some advanced planning aspects to it. And there's things like, okay, moving expenses are now permanently, not something you can get a deduction for, or miscellaneous itemized deductions. Those kind of things are going away permanently again, permanently. I'm doing air quotes if you're just listening. But those are really not advanced planning topics. SALT deduction, there are some opportunities with trusts and stacking and that type of thing. But there are some provisions related to businesses and estate planning, which we'll get to in a while, I'll assume. But Steve, you've looked at OBBBA as well. Is there any particular area that you think was good or bad, or any kind of ahas that you come up with?
Wow. With our limited time, I mean, there's lots of ahas. I'll just throw out a few. A big one that I run into is just a misunderstanding about the senior tax deduction. This has been read by some who obviously didn't read the law to make it sound like Social Security is no longer subject to income tax. Well, that's not correct. It's simply a deduction for some seniors in lower tax brackets, and it's set to eventually sunset. So what I'm getting at is, Social Security is still subject to income tax. Now, I think an interesting planning change in the advanced markets will be with Roth conversions. For more affluent people, these used to be a no-brainer. Why wouldn't you do a Roth conversion? But now we have to be a little more careful. And what I'm getting at, when you really dig into the law, what happens is too much income in any one year, for example, from doing a Roth conversion, can really wreak havoc with taxes. It might drop that SALT deduction you refer to. It can cut into the standard deduction for wealthier people, and otherwise just blunt the positive aspects of Roth conversions. All I'm saying is that far more sophisticated tax modeling really is going to need to be done now to really figure out the best way of approaching income taxes, particularly for the affluent. And then the only other one I'd bring up, and we'll see what else comes up, but charitable tax planning, that's really going to need some careful modeling, particularly for the affluent. It's great that we now have the $2,000 above the line charitable deduction built in the process. It's great. But there are some takeaways. The 1% floor for charitable giving, the strange 237th percent rule for deductions by people in the 37% tax bracket. I'm just saying the tax planning software people, they're going to be real busy for the next many months or years. Well, enough said on that. Mark, you work a lot in business planning. What do you see as some of the highlights from OBBBA regarding business planning specifically?
Well, it looks very favorable, from a business standpoint. If you're familiar with the QSSB, qualified small business stock, that's something that, a lot of people weren't familiar with because maybe it wasn't something they could take advantage of. Essentially, if you owned stock for 5 years, you could get 100% exclusion, but it had some limits on how much could be fully excluded from capital gain, as well as how big the business could be. Well, there were some changes to that. So now, even if you've held something for 3 years, you can get a 50% exclusion, 4 years, 75%, 5 years, 100%. So to your point about the software, it's like, okay, we'll need that for that. But also it's something, the limit has gone from 10 million to 15 million. And also the gross amount of assets has gone up as well. So from 50 million to 75 million. So that's something where it's an opportunity to, as an investor, kind of, get more incentive to invest. The other thing when it comes to business planning, and this may or may not be an advanced planning type topic, but it's definitely something that's going to take some ciphering. How are we going to do this? It's with respect to deducting assets that you kind of put to work within the business. And it's kind of like the Oprah, you get a deduction. No, you get a deduction. You get a deduction. There's bonus depreciation, which is under 168K. There's this new qualified production property, 168N, and there'll be no quiz about these numbers, but there's domestic research expenditures, 174A, and then our favorite, the 179, deduction, rather than having to depreciate assets. And that's really what all four of these that I just mentioned are getting at. It's like, no, you can deduct this right away, take the benefit right away. So that 179 deduction went from 1.25 million up to 2.5 million. Now, these do have limits, but they're all designed to kind of get assets kind of back to work. So that's what I would say is a positive if you're looking at it from a business standpoint. Well, you've mentioned, we've been talking about OBBBA, but you and I have also been talking about how important it is to comply with the rules and how important it is to understand the rules. Can you talk a little bit about how advisors and clients need to really be careful to see what's new and how it applies and what they're supposed to do?
Yeah, and This has been a theme I've just picked up on, and really in the last few months. I've really heard people say things like, well, the IRS is a paper tiger. They won't be auditing anyone for a while. Boy, is that dangerous. I'm even picking up kind of a don't sweat the details attitude about tax planning. And as you and I know, that all that could do is end up ugly. So, just some examples. First of all, the government is quietly rehiring IRS agents. We heard a lot about the big cuts and everything, but they have quietly realized they need to bring in revenue, so they're building up the IRS again. And second, both the IRS and the courts in this year, in 2025, have really been showing themselves to being, for lack of a better term, fussy. For example, we've had several private letter rulings on inherited IRAs. They're making it clear that taxpayers really have to carefully follow the rules for beneficiary designations of IRAs, or they lose things like stretch IRA rules for surviving spouses. Or Mark, you know about the Griffin case. Now that one was crazy.
Yeah.
What we had was a lawyer in an estate case. He failed to affirmatively elect Q-tip treatment for his client. It's something that's pretty vanilla. Well, the IRS accordingly came in, denied the estate's entire marital deduction, and the tax court agreed. Well, why am I telling you this is because this boo-boo led to the loss of a $2 million estate tax deduction because of what really was a simple mistake. I guess my point in saying this is that advisors really need to encourage their clients not to get sloppy with details and paperwork just because there's some strains on government spending and the Doge effect on IRS. The IRS is still there, and they have their computers, and they're still looking for errors and fraud. And in fact, I was thinking about this. Let's talk about another case where the failure to attend the details led to disastrous outcomes. What I'm getting at, Mark, it's hard to believe, but it's been over a year since the U.S. Supreme Court came down with the Connolly case. So what's your read on what this means for business planning as we go forward?
Well, some interesting things about Connolly, but start out for those who haven't, since it's been a year. Essentially, Connolly was a valuation case. It dealt with a buy-sell agreement, and essentially the two brothers who owned the business, they had a redemption agreement in place, and they funded it with life insurance. So there's life insurance held by the corporation. The majority shareholder brother, he died. They had the buy-sell agreement that essentially, as you mentioned, did they cross all the T's? Did they dot all the I's? They didn't necessarily follow the agreement, so that's how it became a valuation case. But even with what the agreement said, the agreement essentially had one set price that was not taking into account the fact that these life insurance proceeds were going to be paid to the company. So the estate said, oh, the estate's only worth this amount of money because the business interest is based on what the valuation / purchase price for the redemption is. But the IRS came back and said, no, wait a minute. Those proceeds, your share of those proceeds as a majority owner are also going to be part of your estate. So again, just like that Q-tip case, the IRS is sending an additional bill to this particular estate. But three kind of points I get from that. One is kind of what you mentioned. It's a Supreme Court case. We've been smiling, nodding our heads about, changes in the tax law. It is tax geek heaven to say, this is a Supreme Court case where you can listen to the proceedings and hear justices talk about cross-purchase versus stock redemption and funding it with life insurance and other opportunities. So from one standpoint, it's interesting that, the things we actually talk about really matter to live taxpayers. The other is, it's kind of one of those too good to be true stories. We'll go back. TAMRA was 1988. That's what also brought us modified endowment contracts. Mm-hmm. Prior to that, you could have, life insurance could be a little bit more overfunded, and pigs get fat, hogs get slaughtered. That's what caused that. It's like, hey, this stuff's great. Just keep putting money in. The other thing is equity split dollar came out in 1964, ruling 64-328 for those taking notes, that essentially allowed equity split dollar to become almost like a cottage industry. I remember people were buying out medical practices, and part of the payment was equity split dollar because it was magic. Now, you can still do split dollar. It's essentially using someone else's money to fund a life insurance need. You can still have life insurance with its investment aspects. Just watch what the modified and endowment contracts are, and it's not an investment. I'll keep that clear. But now this redemption case with Connolly, prior to that, there was a big assumption that, okay, the value of the business in a redemption, we can say it's not impacted by the life insurance proceeds because there's essentially an offset for the obligation that immediately comes up. But that kind of changed with this pretty clear Supreme Court decision. Now, can you still do buy-sell agreements? Of course. Can you still do redemptions? Sure. Can you still fund them with life insurance? Yes, but people are going to be very wary, particularly with majority shareholders, about should we do a redemption? Well, a cross purchase is more of a pain. So any thoughts on that, Steve? I don't want to, before we get into what could you do, anything to add?
Well, I think this proves the value of working with advanced markets and knowing what you're talking about, because as you and I know, there are solutions around this. I mean, you can use a trust deed buy sell, and we won't go into details here, but you could certainly use some kind of a business continuation general partnership or LLC and essentially work your way around some of the concerns we have with Conley. But I guess what it does tell us is you really have to spend some time on it and know what you're working with. It's not for the light-minded to deal with this and think they've got the solution in one fell swoop.
Yep. Yeah. So that's something that is on a lot of people's mind, and we'll see how that continues to play out. Something else that's a hot topic in 2025 relates to Social Security. We had the Social Security Fairness Act. We've seen that, the trust fund's going to run out in 2032 or 5 or whatever. You mentioned how what you're recognizing as income, whether it's Roth conversions or other things, can impact not only your benefits, but the taxability of your benefits, how much you have to pay, for IRMA, that type of thing. So can you talk a little bit about what you see with the state of planning for Social Security going forward?
Yeah, in fact, this is one where I think we could take some of the complicated and maybe make it a little easier. I've really been, being of a certain age, I've been really pressed by friends and neighbors about Social Security filing. And when really pressed, I just would offer this bottom line. You need to do a lot more work than this, but the bottom line is if you're someone who's at or near filing for Social Security age, let's not overthink this. You're probably still safe. I mean, the fact is there's an electorate. They're going to have to do something because otherwise we run out of money just because of the demographics in the United States in a few years. So that tells me don't elect early for your Social Security just because of this get it while you can mentality that I'm hearing right now. So if Social Security reduces, it's going to reduce for everyone. And if you elect too early, what happens is you're going to be penalizing yourself with a permanent reduction. And then the third thing I'd say, and this really is kind of a planning consideration that we didn't have before. If you're in your, let's say, younger 50s and you're starting to do some retirement planning, especially if you're affluent, what I would do is build in a haircut in your Social Security projections. What that's going to do is we don't know what Congress will do. They'll fix it one way or another, but not without a cost. And so this would factor in possibilities like having a later full retirement age, maybe age 70 instead of 67, or maybe increases in FICA taxes. So yeah, a haircut might make sense for younger individuals in their planning for retirement. That is a bit of a change from what we had before. So as we're approaching the end of the discussion of advanced markets topics, and particularly in light of OBBBA, I'm just going to ask you, Mark, any other thoughts? What else is on your mind about this?
Well, again, I'm glad you're saying OBBBA rather than the One Big Beautiful Bill Act, because I missed the B's. But one of those B's is big. And one thing I noticed, yes, the estate planning exemption equivalent essentially is going to be reset at 15 million. It didn't go away. We're not going to have this big rush for attorneys to do this gifting and all this stuff at the end of the year because it's now permanent, 15 million plus a COLA. But what I also noticed is even though the B stands for big, there's some things that weren't in there that we've always kind of kept a watchful eye on. Things like, okay, they're going to eliminate the ability to do short-term grants, grantor trusts. Are slats going to go away? What about the big one, the inside buildup? Is that for life insurance cash value? Is that in there? It's a big bill. What about minority interest discounts, FLPs, that type of thing? Well, none of that was in there. And you look at some of the lists of some members of Congress. It's almost like going to a seminar. Their list of what they want to get rid of is the same as the agenda you find for, an estate planning meeting, but a little different purpose. But none of those were really in there. So the good news is, okay, now it's a permanent estate tax exclusion and it's going to grow. It's 15 million, it's going to grow. Well, as we all know, permanence is permanent as the first 12 acts that you mentioned at the beginning of this webcast. So I think, again, there's a lot of focus on taxation, individual income taxation, a lot of positives for businesses. One estate change was essentially, carrying this over, and we're still at a very large exemption. But I think overall, it is big. There's a lot of interesting stuff in there. But as you mentioned, with respect to some of those cases, you got to pay attention. And as an advisor, you got to work with people who know what they're talking about, because you don't want to mess up a Q-tip election or do something where you've taken out too much money and impacted your future self, through that type of thing. So that'd be some of my points.
And I think that tells us, even though we made these comments about permanent, not permanent, sunset, pay-go, all that, we do have a law, and it's been passed. And really, it has a lot of things that are permanent until something changes. But I mean, that's what we're going to work with. So for the federal estate tax, we really do have a much better idea of where we stand for now. With income tax, I think we have a lot better idea of where we stand for now. There are some things in there that are sunsetted, but a lot of things were made permanent, like the tax brackets and all that. In the area of business planning, as you pointed out, all these great opportunities. And they made QBI permanent, so that's a 20% deduction that is going to apply to a lot of people and a lot of our clients. So we have a lot of things that have been made more workable. We know what we're dealing with as we approach all this. So I think that's all the time we really have for the episode. I think we covered a lot of points. And I want to thank you again, Mark, for this excellent discussion. For both of us, it brings back some memories of working with tax laws in the past.
Yeah.
And just makes it fun.
Yeah.
And for our listening audience, stay tuned for more on OBBBA and other advanced planning topics, because really, American College of Financial Services, hey, we know about this stuff and we're here to help. So thanks.
That's all for now. But you can find all our episodes on YouTube, Apple Podcasts, Spotify, and most other streaming services. Be sure to like us, follow us, and leave us a rating and review. Shares is a production of the American College of Financial Services, and we hope you join us next time